here if you have enough space.
All right,
Nah,
cool.
not yet. When you
What's up, everyone? I know we're going to get started here in 1 minute. Just real quickly before we get the ball rolling. As I mentioned before, note takers are money makers. So if you're here in the building right now, if you're here in the Zoom room, I know you're here to make some money. I know you're here to learn something. So I encourage you all to find you a little notepad, a pen or paper, so you can write things down. Because I will tell you this, the stuff that I have on my slides is not the stuff that I'll be saying. So I want you guys to be listening to what I'm saying alongside the slide. So this way you're properly prepared. There's also, there's a disclaimer down there in the bottom. Noble Living and Langley Ori Enterprises. This is solely for informational and educational purposes only. I'm not a financial advisor. I'm only here just giving my recommendations and giving my knowledge, but please do your own due diligence. Please do not take any investments without prior knowledge or without prior research on your own and doing your own due diligence. Okay. I am not held accountable for anything that you use upon this call to implement, but please do your own research. This is solely for educational purposes only. All right, guys, let's hit the ball rolling. All right. Today's topic is simple. We're talking about building your wealth portfolio. Yes, like Javier said, we changed the long-term investing channel to generational wealth or generational investing because that's what we're trying to do. We're trying to teach people how to build generational wealth. And the thing is, I'm going to hit on a few different angles today because your wealth portfolio is not just related to the stock market. You can have your wealth portfolio in several different things or several different areas. I'm going to touch on that very briefly today. But again, I know we all are here to be investors inside the stock market. So that's one of the areas that I will be hitting on. But your wealth portfolio, again, can mean a lot of different things. But to get us going, I need to first understand, what does wealth mean to you? So I need some people in the chat real quickly to just drop what wealth means to them. What does generational investing, what does the terminology of wealth mean to you all, some of you all that are here? Okay, Asia, I like it. Time freedom, I like that. Let me get a few more. What does wealth mean to you? Because wealth means something different for everybody. I'm not going to lie to you, right? Like wealth can mean a time freedom. It can mean, buying what you want when you want, or being able to do something to pass on. All right, that's fire, Brandon. Holly, choices. I love that. Bilal, wealth is when assets pay for my liabilities. Oh, that's fire. Securing the future of my children's children. Oh, she's talking about deep. She's talking about 2 generations deep. I like that. Knowledge to pass on. That's right, JR. Knowledge, right? That's not just assets alone, but it's knowledge. And yes, these are so many amazing answers because that is what wealth is. It is a lifestyle. It's something that we're trying every single day to create, not just for ourselves, but for the people who come after us, the people who came, before us a little bit, right? Our parents, if they're still alive, our grandparents, if they're still alive, but it's primarily for ourselves, so we can live a different life or a different lifestyle than that we were raised in, or to set up our children, our grandchildren, great-grandchildren, to give them the opportunities and the benefits that we did not have. So this way you can get paid while being lazy, or you can make money while you're sleeping and not actively working. These are all principles of wealth, right? So the thing is, I have to get us started because we have to understand first what wealth is at the fundamental basic level, because there's a difference between income and wealth. And I know that a lot of you all here are traders. So I know that you guys understand what income is. I understand that you understand what making money is because you've done it with your options contracts. You have done it in probably sports betting. You've done it in starting a business. You've done it in several different ways. But the thing is, you have to understand that there's a clear differentiation between income and wealth. It's because wealth is an accumulation of valuable economic resources that can be measured in terms of either real goods or money value. Like that's what wealth is. So wealth measures the amount of valuable goods that have been accumulated at a given point in time. All right. While income, it measures the amount of money or goods that is obtained over a given interval of time. So income represents the addition to wealth, over time, or the subtraction of wealth if it's a negative, or if it's negative, right? So it's income basically adds or takes away from our wealth. And the big thing that I need you all to understand here, that the big word between wealth and income is this word right here. Oh, you can't even see my little arrow. Oh, my little, there's this word right here, accumulation, right? And that's the thing. One is creating, income is about creating, while one is stacking. Wealth is about stacking. You know what I'm saying? Stacking. We're not talking about stacking bricks here. We're talking about stacking bricks of money. We're talking about layers. That's what wealth is. So I have one question for you all today. I have one question. How are you building wealth if you keep selling or you're never buying? Like, that's what I really want to know. Like, how are you going to be talking about building generational wealth? How are you here saying that you want to have time, freedom, and time? Or how are you going to say you want to make money while you're sleeping? Or how are you going to say you want to give something to your children or your grandchildren? Or you just want to be able to live a lifestyle that nobody in your family has ever seen before, but you aren't building wealth, or you keep selling or you're never buying? Like, I'm not understanding that. Like that, because remember what I just said, wealth is an accumulation, right? Like, it's an accumulation, you're stacking. So if you're never buying or you're continuously selling, how are you stacking? Make that make sense to me. How are you accumulating assets if every time something goes wrong, you let go of it? How are you accumulating assets if when you need to be saving, again, accumulating to invest in that next project, but when the opportunity presents itself, you're not ready? Like Bilal said, the formula doesn't add up. The math is not mathing. So I really want you to think about that today. And I have a few reasons as to why you might be selling or you might not be buying anything. This is common. You're not alone. I want you to understand that. There might be a reason why this is going on, right? Because the first reason why you're selling or you're not buying is because you're fearful. You're scared. And I understand it, because fear stands for the false evidence appearing real. So you hear things such as the stock market crashing. You hear stories about people who've took out a second mortgage and invested it in crypto. And next thing you know, they're upside down. Like, you hear stories about people going through different things when it comes down to the markets, and they tell you it's a casino and you can lose money, or markets crash because somebody over leveraged their portfolio right before the dot-com bubble in 2000, or right before the housing crisis in 2008. Like, you hear certain things and you're scared because you don't want to take the risk, because the cash in your bank account and your savings account looks a whole lot better, because that doesn't go up or it doesn't go down. It just stays there. Is that making sense to somebody this today? Like, you're a little bit fearful just because you know that once you put this out into the marketplace, once you take this money out of your account and you invest it, there is a possibility and there's a chance that you can lose this money. Remember, poor people only look at what something costs them. Rich people look at what something can gain them, or the value they can get from it. So understand that the first thing that you have to do is you got to do a mindset shift here. That's like one of the keys. Somebody in here has been trying to figure out how to build their wealth portfolio, but they're not changing their mindset first. So I need you to get out of the mindset of being fearful. I need you to get out of the mindset of not taking risk. I need you to get out of the mindset of not taking those leaps, and just really hone in for me real quickly, because I want you to know that it's possible. And I'm going to explain that today. Another reason why people might not be building their generational wealth account, or in terms of the stock market, or you might be selling, is because you're simply building something else. And that's okay, right? Because you need to be building something. But I'm here to tell you that if you're not investing in the stock market and building your long-term wealth portfolio, there's 10 ways for you to get super rich. Ultimate riches. And I got this from the book, The 10 Roads to Riches by Ken Fisher. And I do a whole training on this, and I'll probably do one later on for you guys. But I want to give you the 10 roads to ultimate riches. This is not the only way to get rich, but this is the way for you to reach $100+ million ranking, $1 billion ranking. Again, I got this from The 10 Roads to Riches by Ken Fisher. It's a fire book. His net worth is over $10 billion. He's one of the top hedge fund managers in the world. So don't take my words for it, take his words for it. Okay, there are 10 ways for you to build something. All right, the first one is to start a business. The second one is become somebody's number. Okay, let me go back real quick. Starting the business, and building that business to a very sizable amount, okay? Think about like Mark Zuckerberg, all right? The second thing you could do, or you could be building, is becoming somebody's number two, the Robin to somebody's Batman, and you're helping them create something bigger than yourself. So everybody knows Bill Gates, but do you know who Steve Ballmer is? Steve Ballmer he is the owner of the Clippers. He's the former CEO of Microsoft. So the thing is, he decided that Bill Gates' vision, Bill Gates' what he had in an idea with Microsoft made sense. So he took his time, his energy, his money, and invested it with Bill Gates and became his number two. All right. The third way for you to get ultimate riches and ultimate wealth is becoming the CEO of an existing firm or business and growing it to a substantial amount. Okay, so this way you can either sell it with private equity, you can cash out with your shares, but you have to become the CEO so you can make the executive decisions and you can help it grow. Or you can join the C-suite and help make those decisions, but you have to be building a pretty sizable company. Again, these are the 10 roads of riches for ultimate wealth. If you're building something outside of your wealth portfolio, you need to be doing one of these. The fourth thing is you're turning celebrity into wealth or wealth into celebrity. So think about musicians, artists. These are people who
my man, no boy.
You're good, bro. You're good, bro. You need to be turning that money, that if you are a celebrity, you need to be turning that money into wealth. Or you could be like somebody like, so think about Jay-Z and Beyonce, they turned celebrity into wealth, right? Or think about somebody like Jim Cramer. He was a wealthy man first and then he just turned that into celebrity, okay? That's the fourth way to the ultimate road to riches. Number 5 is you're gonna marry well and you're gonna marry really, really well. Okay. And there's the thing is you can be very intentional about who you marry. You can set yourself up for who you marry. I have a whole training on that as well, about putting yourself in the right positions in the right places. So this way you can bump into the right people, because you're tired of finding ain't shit niggas because you keep finding them in the club. I mean, there are ways for you to find the right person who can align with your values and your beliefs and who also actually want to go where you want to go in life. That's a way, that's a play. Okay. Number 6 is you can get into plaintiff's law. Most of you probably won't do that because you don't want to go and get your JD. But if you're a plaintiff lawyer, there's stupid money in getting into plaintiff's law. And if you don't know, if you ever seen those commercials on TV that say, if you've ever been hit by a car and you've suffered injuries or damages, or if you have taken this prescription drug and you've ever suffered injuries or damages, you might be entitled to some compensation. That's plaintiff's law, because what happens is these guys go put out a lawsuit on whatever pharmaceutical company or whatever person or company that hit you. They sue them for $100 million or $5 million, $10 million. And after all years of litigation, they end up settling, and 99% of the time, the person who actually got injured gets like 30% of the money. The other lawyers and everybody else gets the majority of it. Okay. Number 7, managing other people's money. That is, if you're in the financial world, hedge fund managers, stockbrokers, money managers, like that's another road to wealth. The richest, the number 1 industry in the world that has the most billionaires is the financial industry. And it's from money management of financials. Okay. That's where I got my background in. Number 8, create an endless future revenue stream. Okay, think about royalties from your music. Think about royalties from inventions. Think about books. These few are network marketing. Think about a future revenue stream that is endless, that you can get paid consistently over and over and over again. Number 9 is real estate. You get into real estate, okay, but specifically multifamily home and real estate. You can make a lot of money. You can do well in single family homes. But the thing is, if you're trying to get to that like super high, ultra wealth level, you have to get into multifamilies. You got to get more doors. You got to get more people inside of your units. Like that's the way to get to that super high level. And number 10, where most of us might fall in, or somebody in here is falling in, you got to save really, really well. You have to be conscious about your spending habits, and you got to invest well forever. Like those are like the 10 ways for you to build. I'm talking about opulence. I'm talking about real wealth. Okay. If you're not focused on building out your long-term portfolio in the stock market, or building out your long-term portfolio in the real estate market, you need to be building something, and they should be directly aligned to something that can compensate you to the utmost. such as a $50 million net worth or more. And I just went through that, okay? The other thing that you might be doing is why you might be selling or you're not buying is because you're waiting / pivoting for a specific opportunity. And that's okay. You're stacking because you're preparing for the next opportunity. Right now, one thing that I'm preparing for is I'm preparing for real estate, because for me, I just think the housing market is just oversaturated. So I'm going to wait for rates to rise. I'm going to wait for some of the people who bought homes in the last few years to foreclose on some of those properties because they over leveraged themselves. They got over their heads. And my goal is to go in and start buying and scooping them up at low prices. So if you're waiting and you're pivoting, you need to be having an exact plan. If you do not know where you're going, then you need to be starting to build your long-term stock portfolio. But if you have a specific play in which that you're trying to set yourself up for, that's fine. And I'm not talking about timing the market. Okay, so I'm not saying you just buy when you see a bottom, but I'm talking about taking advantage of opportunities, because the acronym for POUR is passing over opportunities repeatedly. And we got to stop doing that as a culture, as a race. We got to stop passing over the opportunities. So we need to start educating ourselves so this way we're prepared for when the opportunities come our way. All right. And the last reason why you might be selling or you are not buying is because you just need some direction. Like, you just know there's a bunch of avenues out there. You're like, I see NFTs, no, I see cryptos, I see stocks, I see real estate, I see entrepreneurship. Like, you see all this stuff going on, but you're just literally like, I need some direction as to where I need to go. Like, there's plenty of ways for you to build wealth. I literally just gave you like 12 plays, but you're just not sure how and what to accumulate, right? But today I want to talk specifically on why you should be building your stock market portfolio, because I know that's why you're here. You guys are traders. You guys are investors. You are over here trying to get that. Okay. So why build your stock portfolio? Because the first reason why you need to build your stock portfolio is because of ownership. We as a culture, and I'm talking about specifically to my African-American and Black, I don't even say African-American for real, I say Black people here, my people of color here, we need to start getting into the mindset of ownership. Do you understand that we're the only culture and the only people that don't really own anything? Like, real talk. Like, we don't even own our own communities. That's why we get hit with gentrification. Like, we shouldn't be getting hit with gentrification if we own our communities. Like, we don't even own our biggest assets, our biggest things. And we wonder why we're left behind. Okay. But this is the beautiful thing. When you have ownership, you're part owner of the company. As the company moves, you move. And the thing is, with ownership, it can be passed on. When you literally buy a stock, you have all the rights and ownerships to a part owner of that company, unless you sell or unless that company gets bought out. So then normally they'll do a stock conversion, or they'll pay you out for your portion, or that company goes under. Like, those are your only options. So the thing is, if you're buying and holding, you have something to give to your children. Another reason why you need to build your stock portfolio is because you've already started. Majority of us have a retirement account. Majority of us have work a 9 to 5. Majority of us have something called a Roth IRA or 401k. A Roth IRA is an individual retirement account, and it differs a little bit from your traditional IRA because you're funding the account with after-tax money. So when you withdraw it, it isn't taxed, okay? But your 401k is your employer-sponsored program, and a piece of your paycheck goes into this account every time, right? And it's pre-tax. So most employers offer a match, typically of 50% up to 6% of the employee's salary. Here's another play for you to start building out your long-term portfolio. Take advantage of the max. Take advantage of the max. It's free money. So if your corporation is offering you a max in terms of your 401k match, take advantage of it. And the thing is, here's the next way to look at it. What type of accounts are you investing in? When you're telling them, okay, hey, I need you now, my 401k, what should I be investing it in? Should I be investing in emerging markets? Should I be investing in large caps? Should I be investing in small caps? Should I be invested in just tech? What should I be investing in? We're going to dive into that a little bit further, but I want you to know that you've already gotten started on this process. You just probably didn't even realize it, or you weren't being intentional about it. When was the last time you checked your brokerage firm that your retirement account is going to? When was the last time you checked the portfolio value of it? Probably right now it might hurt you a little bit and be like, ugh. But when was the last time you really just looked to see if the money manager that you're paying, because you're paying them a fee, is actually doing what you need them to do? See, the world is full of obvious things which nobody by any chance ever observes. Sherlock Holmes had said that, and I think it's a beautiful quote, because the thing is, it's really obvious to me. The stock market is super obvious to me. But what my thing is, why is it that nobody notices this obvious opportunity that's right in front of us? The stock market is too big to fail. So why are you not invested in it? The stock market is too big to fail. You're like, no, well, nothing's too big to fail. Okay. Since you've been alive, I want you to know, I want you to ask you, have you seen businesses? Like, is there a time in your life you have never seen a business? Like, businesses are everywhere. So please tell me when you haven't seen a business. So where do businesses congregate? The stock market. Too big to fail, right? COVID-19 showed you that the government will pump any money that's necessary into the economy to boost the markets. Why? Because there's too many people's lives at stake if this thing goes under. It's too big to fail. Think about this: capitalism, which is an economic and political system in which a country's trade and industry are controlled by private owners for profit rather than by the state. We here in America, we have a democratic capitalistic system. You know what makes capitalism work? Do you know what the underlying fundamental of capitalism is? It's competition. And do you know what businesses do? They compete. So we're too big to fail. The market is too big to fail. So why are you not involved in it? Look at the S&P 500 90-year historical chart that I put right here. Okay, yeah, there are dips. Yeah, there are times when we're not always in the green, right? But look at it over the long run. That's what we're talking about, right? Generational wealth. So if your great-great-grandparents had left you something, but probably we couldn't have it because we were slaves, but if they gave you a little something in 1950 at about 250, do you think that might be worth a little something today now that the stock market's S&P 500 is over 4,000? You think that's generational wealth? Don't let me pull up the Dow Jones chart. That thing is a monster. Like, this is what I'm talking about. Like, the market's too big to fail. The historical data is there. Over the long run, the markets are going to pay you. You just have to be involved. But here's the kicker. Here's the thing that you guys came to hear, and that's going to rustle some feathers on some people who might leave the Zoom chat after this, and I understand. Stop preparing for retirement and start building for your and your family's future. What, Noble? What? What you mean? See, you're scared. You don't have the money. You're not taking advantage of the present day opportunities because you're preparing for retirement instead of building your future. It don't sound so fun now, right? When I say you're 26 years old, but you're preparing and living like you're 66. It don't sound so fun, right? If you're currently not investing or you're not all in on one of the roads or one of the 10 roads to riches, like I mentioned before, you are preparing for retirement. And listen, that's fine. It's okay to prepare for retirement because you can still live comfortably. Like I said, rule number 10, if you save well, if you invest well, if you take the right steps, if you take the right precautions and you inch along, you take the baby steps, like, it's okay if that is your goal. If you're a little bit older in here and like you're saying like, no, but I just don't have the ability to take the risk that other people do just because of my age. I understand that, but just understand that you're preparing for retirement. But if you're wanting real money, if you're really wanting opulence and wealth, if you believe that abundance is your birthright, I need you to drop a gem in the chat real quick. If you believe that this is you, I need you to drop a gem in the chat real quick. Like, if you believe that you're not preparing for retirement, that you're that you're living to build something that you can pass on, I need to see some gems. Okay, I see you, Asia. I see you, Cornelius. I see you, Brandon. That's what I'm talking about. You see, if you don't know how the stock market works inside and out, especially in the long run, but you have a 401k or a Roth, you're preparing for retirement. What? Hold on. Because this thing, 68% of employed Americans have employer-sponsored programs, and 41% of them contribute to their 401k. So what that tells me is that over 60% of people are preparing for their retirement. According to the Investment Company Institute, 37% of households had an IRA as of 2020. That's great. These numbers are amazing, right? Like that means that we're preparing for retirement. At least we're taking the financial future into our hands. But here's the kicker. The 401k savings plan, right? The 401k America, that's like the go-to one here in America. I just said 60%, over 60% of people have one. Was not created until 1978. The Roth IRA wasn't started until 1998. So the thing is, you're putting all your time and attention and focus into something that hasn't even been around that long. Make it make sense. The math isn't mathing, right? Like you're taking all your time and energy, you're taking your hard-earned paycheck, and I understand the principle of saving for retirement, but there's some people in here who are over-contributing to the max because they're worried about their future, but instead of taking that extra money and building something for themselves. Or they're depending on money managers at E-Trade or Fidelity to do the work for them instead of saying, okay, let me figure out the stock market. Because I just showed you the stock market's been around since before the 1900s. But your focus is on something that came out in 1978 and something that came out less than 30 years ago. Make it make sense. But this is the thing. I want you guys to understand that you guys will be fine. You'll be all right. All right, like that's what I want you to understand, because let me tell you this, all right? I want to read you guys something from The Psychology of Money. If you haven't gotten this book, you need to get this book because it explains long-term investing better than just about any book that I've ever gotten, right? It reads one thing in here, says on page 21, it should be no surprise, it should surprise no one that many of us are bad at saving and investing for retirement. We're not crazy. We're all just newbies. Same goes for college. The share of Americans over age 25 with a bachelor's degree has gone from less than 1 in 20 in 1940 to 1 in 4 by 2015. The average college tuition over that time rose more than 4-fold adjusted for inflation. Something so big and so important hitting society so fast explains why, for example, so many people have made poor decisions with student loans over the last 20 years. There's not decades of accumulated experience to even attempt to learn from. We're winging it. We're literally figuring this out on our own. Same for index funds, which are less than 50 years old. Hedge funds, which didn't take off until like the last 30 years. Even widespread use of consumer debt, mortgages, credit cards, car loans did not take off until after World War II, when the GI Bill came into effect. Dogs were domesticated 10,000 years ago and still retain some of the behaviors of their wild ancestors. Yet here we are with between 20 and 50 years of experience in the modern financial system, hoping to be perfectly acclimated. For a topic that is so influenced by emotion versus fact, this is a problem, and explains why we don't always do what we're supposed to do with money. We all do crazy stuff with money because we're all relatively new to this game. And what looks crazy to you might make sense to me, but no one is crazy. We all make decisions based on our own unique experiences that seem to make sense to us in a given moment. And let me tell you, this was written by a white man. So the thing is, some of these stats are even newer for us. And some of the handouts, some of the knowledge, some of the education, some of the jump starts we didn't get. So I'm here to let you all know this morning, right, that you need to give yourself a little grace. We are not fully to blame for this. The economic society in which that we've been raised in, the educational system in which that we have been developed, was not made for us to understand these concepts. It was made to keep people average. It was made to appeal to the masses, which means that it's made to appeal to the mean. But if you're extraordinary, if you're above and beyond, then that's what Profit Rocket's about. Then you need to know what you need to do. Because now, when you know better, you got to do better. That's what Maya Angelou said. Like, now you know that there's another way. So why are we not doing it? In James 4, verse 17, it says, therefore, to him who knows to do good and does it not, to him it is a sin. So the thing is, I don't want you passing on. I don't want y'all sinning. I don't want y'all to do things that you know is right, but you're not following through with it. So that's what I need you to do. I need you to make your goals. I need you to take action, because that's what equals success. And it starts with you. It starts with each and every single one of you, because now you know to do better. You've seen the stats, you've seen the charts, you've been invested in the markets, you've seen the millionaires that have been made. You have the access to information. You don't have the barriers that your parents and grandparents had. So my question is, what are you going to do with it? What are you going to do with it? If you know better and you do better and you do it not. I don't want y'all sinning out here. So I want to get down to the nitty gritty. I want to teach y'all how to get into this, and I want to break it down super simple for you. And here's the 10-step investment process for you to understand how to start building out your long-term portfolio. I understand that it's not easy to buy and hold, especially times right now where the markets are getting hit hard. That's why I've spent some time talking about the commitment process. That's why I spent some time talking about mindset. That's why I spent some time going through our history a little bit so you can understand, hey, I understand why mentally that it's hard to stay the course. Because this journey is more psychological, and being able to stand up through the thicks and the thin, through the up and the downs, like that's what it's going to take. And if that means that you have to separate from your brokerage, do that, right? But I need you guys to commit. I need you to commit first, because I want you to understand this is not easy. I want you to understand that losing money when you have a play is not easy. I want you to understand that when you make an investment thesis and you want to see how it plays out, it's not easy, but you need to commit. And the first thing I need you to commit is I need you to decide that you're going to create a long-term wealth portfolio for you and your family. And I need you to have it separate from your options account. I need you to have an options account, that money over there. And I need you to have your long-term account over here on top of whatever 401k or Roth IRA and employee-sponsored retirement plan that you have going on. Because the next thing that I need you to do in the investment process after that you've committed is I need you to observe and be aware. Do you understand the purpose of pre-market prep? Is so that you guys can be aware of what's going on. So now you can plan out your next move. That's why Hunter gives out the plays that she does. That's why Bilal gives out the plays that he does. That's why Seven and Juicy gives out the play that they do. Because they're helping you starting to observe what's going on in the world. And now you can be aware. So now you can start making plays. We talk about rates rising almost every day. In all honesty, who in here has looked up which sectors do well when rates rise? Like who's looked that up? Who's looked at which industries get hit the hardest when interest rates are high? Who's looked that up? Like what happens to the economy in inflation? That's all a part of observing and being aware. And here's the kicker, guys. Here's the thing. You cannot ignore the economics. That's why Hunter is one of the people who talks the most on pre-market prep, because you cannot ignore the economics. All right, let's go. Macroeconomics is a study of economy as a whole. Macro, big. The economy as a whole. Microeconomics is a study of how individuals, companies, and make decisions to allocate scarce resources. Macro big, micro small. Okay, there's two sides to the economics. All right, pop quiz. Unemployment rates, is that macro or micro? Drop them in the chat. Macro or micro? Unemployment rates. Is that affecting the economy as a whole? Is that something that's individual to people, individual to companies? Got it. Macro. Boom. I got you, Mr. Hughes. All right. Let's go again. Increasing gas prices. Increased gas prices, like we've just been seeing. Is that macro or micro? Oh, I got you, Nick. I appreciate you, bro. I see you, JR. All right. Increasing gas prices. Macro or micro? It's okay to guess. All right. We got a few macros. It's actually micro, because it's specific to a specific area. That's what I'm saying. Hey, there's nothing wrong being wrong. Keep answering. That's awesome. It's actually micro though. Okay. Inflation, macro or micro? Attaboy, Kevin. Yup, let's go. Macro. Okay. Price discrimination and rental units, macro or micro? Micro, boom, there we go. Now y'all understanding it. Macro, economy as a whole. Micro, smaller individual companies, smaller specific industries, niches that roll up into the bigger economy. You have to know this. You have to know this when it talks about building out your long-term portfolio, okay? I can give you one example of how you can observe and be aware, all right? I've given the example of UPS several times. in here, because to me, that's just like one of the easiest examples to give. When my girlfriend at the time during the pandemic, she was online shopping. She kept ordering things to the house. I kept seeing UPS trucks pull up, but I also lived in a cul-de-sac, so I got to see obviously other homes as well. And I kept seeing FedEx trucks and UPS trucks drop off packages at their homes. So I used to see packages on the front of their doorsteps. But then I also realized that FedEx and UPS was running later than usual. It ain't usual that you got delivery men dropping off packages at 4 o'clock. I mean, excuse me, at 9 o'clock at night in April and May. It's not Christmas time. So at that point, I was like, hold on, let me observe, let me be aware, let me do a little bit more research. Boom, and looked at their stock. Their stock was at like $70 at the time, UPS. And guess what I did? I bought them. Right now, they're trading at what? Like 170, 200. I haven't looked at it, okay? Another example, Lululemon. I went to UTC, right? University of Tennessee at Chattanooga, predominantly a white school. It's like 3,000 Black students and like 15,000 white students. You know what white girls love to wear? Athleisure leggings. Like they just love to wear them. Okay. So I kept seeing all these girls walk around campus with these little leggings on, these like little sport bra thingy majiggers. I'm like, bro, what company is that? Oh, it's Lulu. And I'm like, oh, okay, cool. Let me do some more research. Why do I keep seeing so many people do it? Why do they have so much brand loyalty? Why is this? Or people spending more money on athleisure clothing? That's how you observe and be aware. So now you can start being able to form your investment thesis. At the time, Lululemon was $50 a share. Look them up right now. That was back in 2016, baby. So what I need you to do once you start observing and being aware is I need you to start creating a watch list. And this is separate to your options watch list. What? You giving me more work? No, yes, because options trading typically tends to be short-term. Short-term trading and short-term watch list is completely different from long-term, okay? If you listen to pre-market prep, you typically hear Seven, Juicy, Bilal, they put out similarly the same tickers. If you notice, Tesla, AMD, Microsoft, they put out similar names. You know why? Because in options trading, technical analysis is more important. Technical analysis is important. Is pattern recognition. Those two go hand in hand, right? So that's why it's important for you to trade the same stocks over and over again so you can understand how the stock moves, so you can understand how the pattern moves. But in long-term investing, you don't need to do that. What you need to do is you need to have 75 to 150 stocks. What did I say? 75 to 150 stocks over the 11 sectors. So you need to have stocks that you like in each sector. Okay, I build out my watch list in the app called Seeking Alpha. That's my go-to, because at the end of the day, they give me a quick percentage of what stocks went up, what stocks went down. When the 4 o'clock bell hits, they give me a rundown. I just like Seeking Alpha because they're fire. But this is the thing. You have to narrow down your choices. Okay, you have to narrow down your choices, but I'm going to get to that in a second. So how do you narrow down your choices? Because understand this. A confused mind always says no. A confused mind always says no. So if you're confused, if you have way too many stocks that you're looking at, you're going to be confused. You're not going to pull the trigger. So what I need you to do is I need you to start watching, tracking, and doing preliminary research on these companies that you are now going to start narrowing down this list. Okay, because those are the last 2 steps. Watch and track preliminary research, narrow down the list. So let me help you do this. What are you looking for in your preliminary research? What does the company do? You need to be knowing what the company does, where they're headquartered, how long they've been around, who is the CEO of their company, how long has the current management been in position. These are all things these are just basic essentials to know. These are just basic essentials. Like if there's a company and they've had 3 CEOs in 6 years, that tells me there's an issue there. That might be something that I nix off the list. You want to then look at any significant moves or price swings. Okay, so look up news on the stock. One thing I like about Thinkorswim is in one of their drop down bars, like you can actually see like where they reported earnings. You can see if like any significant news comes out. Like this is something that you can actually put on the charts of the stock that you're looking at on Thinkorswim. You need to be looking at that because that's going to help you start narrowing it down. A company that looks like this, guys, needs to get off the list. What areas do they make their money in? We got to know this. You need to know where they make their money. And then the last thing I need you to do is I need you to categorize them by growth, value, and income. Okay? And then as you continue to narrow down your list, this is what you're doing during the watching, the tracking, and the preliminary research. This is all preliminary research. There's a difference between growth stocks, there's a difference between value stocks, there's a difference between income stocks. You need to know the companies on your watch list, which ones do they fit into? Some people like to roll up income and value together, but I don't like to do that because some stocks are value plays while some stocks are dividend plays. And some stocks are growth plays, which means that you're looking for simple price appreciation. Then when you narrow down your list, you're narrowing it down to the industry leaders. You're narrowing down to the companies that have a competitive advantage. You're narrowing it down to the companies that are aligned with the macro and microeconomic indicators that go with where we're headed. And you're narrowing it down to the companies that have not shown too much volatility and turnover. Those are some of the things that I'm looking for from companies when we narrow it down. So that's the first 5 steps. All right, let's go to the next 5 real quick. After you've narrowed down your list from 75 to 150 stocks, at this point, you have narrowed it down to like 60, to like 50, okay? You now start doing your in-depth research. After you go on Yahoo Finance and you learn everything about the company and what they do and all the things that they make their money from in your preliminary research, then you're gonna start with the company filings. The 10K, the 10Q, those are the Magna Carta Holy Grail when it comes down to what the company does. Like that's where you're gonna find the most information. But you can also look up company presentations. You can also look up news like from analysts that are on Seeking Alpha. You can look up different things. This stuff is all Googleable, literally. All you need to do is type in UPS company filings and they'll send you to the company website and they'll go give you the 10K, they'll give you the 10Q, they'll give you 8Ks, they'll give you special company presentations, they'll give you stuff to the shareholders. Like there's a bunch of different stuff they'll give you, okay? After that, you want to start looking at interviews with CEOs. What is the management talking about? What are they saying on the earnings call? When they go on CNBC or Mad Money, they talk to Jim Cramer, what are they talking about? All right. The annual report breaks down looking at their financial margins. Excuse me. The annual report is so important because we can break down and look at the financials and the margins and the multiples. Again, this is in-depth research. This is how you start doing your fundamental analysis. Because now when you're looking at the annual report, when you're looking at their income statement, their balance sheet, the statement of cash flows, now you're starting to understand, does the numbers align with where they're headed? Okay. So few multiples for you. Hope you guys are writing these down. You want to be looking at the revenue year over year increasing. That's something I look at. Revenue year over year increasing. Profit margin and net profit margin. Those are two margins those are two ratios that I'm looking at. The net profit margin is calculated as open parenthesis, net income over revenue, close parentheses times 100. That's the formula for net income. Net profit margin, excuse me. Net income over revenue, close parentheses, times 100. You do that year over year, and now you're able to now to see how much the company's net profit margin has increased year over year. If net profit margin isn't increasing, you need to look at their expenses and see what the issue is. Because net income at the top of the numerator of net profit margin is made up of operating expenses. It's made up of cost of goods sold. Like there's different reasons as to why they might have had net profit margin decreasing. Because if cost of goods sold increased, then there might be a reason why. If operating expenses increase because they expand their team, that might be the reason why. So you might need to look into what is the reasoning behind some of these numbers. The numbers alone don't just tell you what's going on. Okay, then you need to look at the debt levels. How much debt does this company have and how are they using the debt? Because debt sometimes for certain companies is toxic. Like some companies are so underwater in debt that they're not profitable, and that really will tell you if it's a growth company or not. And the thing is, you don't want that in your long-term portfolio. That might be in your short-term portfolio, that might be an option trade, but you don't want a company that's misusing their debt. So here are a few debt ratios to look at. Here's a debt ratio to look at. Total debt over total assets. Do that year over year, okay? And if you need the year over year percentage return calculation, ending value divided by beginning value minus 1 times 100. Okay, ending value over beginning value, close parentheses, minus 1 times 100. That will tell you year over year percentage return. Okay, look at research and development, R&D. What are these companies spending their money on in terms of expansion? What are they spending their money on when it comes down to them getting to the next level? That's all of this is in the in-depth research phase. Okay, so what we just started to do is we started to put together an absolute valuation. An absolute valuation is when you analyze the individual company and you see what they do well, what they don't do well, how do they make their money, how do they not make their money, what's their intrinsic value. You're looking specifically at the individual company. That's absolute valuation. But this is the thing. You're not doing in-depth research if you do not know about the competitors. You have to know the competitors. So sometimes an investment is a bad investment simply because they're outmatched, simply because they're over their head, simply because there's somebody else in the industry that's going to outspend them, that's going to outproduce them. Like, it's that simple. So they might not be a bad company in and of themselves, but they just face fierce competition. And that's where relative valuation comes into play. Okay, where you compare competitors. You can simply start comparing competitors by putting them on the same chart together. That's it. It's as simple as that. Go on TradingView, go on Thinkorswim, and put up Amazon next to Shopify. Put Costco next to Walmart. Put MasterCard next to Visa, and just look at the charts. That's the first way that you start doing competitive analysis. Then you start doing research on their competitors and their product lines, their money makers, their direction. You try to see if your company that you're liking, that's on your watch list, has something different than these guys. Do they bring something to the industry? Do they bring something that can set them apart? You have to do the research on the competitors. That's probably just as important, if not more important, than the absolute valuation. And each industry has ratios that are more relevant to them than others. So here's some ratios that you probably heard of, because I said one on pre-market prep this week. PE, price to earnings. That's the most commonly used relative valuation ratio. And what do I mean by relative valuation, guys? It's when you're putting companies next to each other. So this way you can compare apples to apples, oranges to oranges, competitors next to each other. Because if you just put them next to each other, sometimes like a company that has a huge market cap and a small market cap, it's hard to compare them. So relative valuation puts them on the same playing field, because a company like Walmart, of course, they're going to bring in so much more revenue than a company that's just getting started. Okay, so this is how we're able to compare apples to apples. Price to sales, that's another ratio. P over S is big for retail companies and consumer discretionary companies. That's one of the main metrics that you want to look at. For financials companies, insurance companies, you want to be looking at price to book, P over B, or P over BV, depending on where you're looking. Price to book value. Because these companies, financial institutions like banks, they don't have all their assets in cash. They don't have all their assets and profits. They have book values, which is based off of the money that they have loaned out, based on the money they get back from interest, based off of the deposits that they get in, based off what they have in reserves. That's all a part of the book value. You got to know that if you're in the financials. Price to cash flow, P over CF. That's for the real estate or REITs. That's a key metric or key ratio for them. PEG, price to earnings to growth ratio. All right. And the thing is, if you're probably like, all right, man, like, I don't know where to find all this stuff, go on FinViz and go look up whatever company you want to look up, scroll to the bottom, and they literally have all these statistics out there for you. The fun thing is, like, you don't really even have to calculate most of this stuff yourself. If you calculate it yourself, you're going to understand the input, so therefore you'll understand the output. But if you don't want to do that work, luckily it's just there for you. But if you want to understand the input so you can understand how it's going to derive from the stock price and where the company's headed, so to give you the output, then you can calculate it yourself or play around with calculating it yourself, or at least do a few so you can understand what goes into this. Okay? So after you do all your ratios and you're comparing your competitors and you do your in-depth research, at this point, you should now have the ability to create an investment thesis. And I, guys, I thought I was going to be short. If you can see, it looks like we're just going to go for, I ain't got that many slides, but I'm just in the zone right now. So if you got something to do, feel free to hop off, but we're in the zone. We're going past 9, right? If you can't tell me what the company does, how they make their money, where you think they're headed in both the long term and the short term, you should not have them in your portfolio. That's a part of your investment thesis. Like if you do not know this, if you cannot tell me, like when people ask me, why do I love Costco? I can spit out 10, 15 facts as to why I like Costco. I know them like the back of my hand. When people, you have to know your investment thesis. Like when people ask you, hey, why do you like Nike? It needs to be more than they just have comfortable clothes and every athlete wears them. Now, those are reasons as to why they're very profitable, and there's the reasons why they're in the positions they are. But I mean, some of these things are not going to be the things that are going to move the needle for you anymore. You need to know how they make their money. You're going to have to know what direction they're headed. So then after you do that, then you're now narrow down your list even more, because now you're going to know, this company doesn't fit into what I'm looking at, right? A company like Constellation Brands that bought a huge equity stake in Juul, but then Juul is getting outbanned because we have all these electric cigarette legislation coming out, that might not fit with where you think you're going. Do you understand what I'm saying? That's an investment thesis right there. When you connect these dots, okay? Or a company that acquires a company that has nothing to do with their industry. Okay, like you'll see people do mergers and acquisitions that have nothing to do with their industry, like Constellation Brands, that when they acquire, like that's a cigarette company. What's a cigarette electric company doing with an alcohol company? Okay, maybe you can say that they're both, addictive products. I get that. But what I'm saying is that there's going to be some companies out here that are doing things that are not even aligned with where they're headed. You need to know this. Then you look for your entry point. This is where most of you guys know what to do really well, because you guys know technical analysis. You guys are traders. This is where you can thrive, is by finding an entry point. But the goal with your long-term portfolio isn't to always get the best price, but it's not to overpay either. This is also where you take into account the economics as you prepare for your next move. So when you look at the industry, right? Let's just say you have a stock that you really like, okay? If you have a stock that you really like, then you look back at your micro and macroeconomic variables and you say, is this the best time to buy this? I mentioned earlier about real estate. I don't believe that right now is the best time for me personally to buy real estate, right? So because of that, I might not pull the trigger right now on this entry. I might wait for some of these things to play out. I might wait for the economic indicators to align with what I'm thinking. But because you're building out for the long term, because you understand that you're going to commit for the long term, guess what? You don't have to be exact. You don't have to be spot on. And then what I need you to do after that, I just need you to buy. Just pull the trigger. What's stopping you? Just buy. Pull the trigger. If you need to, and I mentioned having a separate account, if you need to have your long-term portfolio, I hate to say it, but in Robinhood, that's okay. Turn off those notifications. And if you're doing your options trading in Thinkorswim, that means that you don't ever have to look over there unless you're keeping an eye on the watch list, keeping an eye on the movement, and you might nibble, do a few strategies, which I'll talk about a little bit later. And the last thing you need to do is you need to balance your portfolio. There are 11 sectors within the stock market. You need to be touching the majority of them. I'm not going to sit here and tell you need to be touching all of them, but it behooves you to be touching all of them. The S&P 500 is not perfectly balanced, so you don't have to be. Look up the weightings yourself. Google S&P 500 weightings by sector. And if you don't know enough about an industry, for an example, I don't know enough about industrials. So you know what I do? I buy the ETF. I don't like, if you don't know about enough about financials, you buy XLF. You just buy an ETF that has the companies that you want in it or that tracks the broader sector. Okay. I worked in professional money management for about 3-4 years. on top of me running a portfolio when I was in college as well. Okay. The average portfolio for long-term is anywhere between 25 and 30 stocks over the 11 sectors. You do the math. Okay. You're not buying 20,000 things here, people. We're not buying a million things. We're buying 25 to 35 stocks that align with where we want to go. And if it's not with us, we nix it and we replace it. And if you don't know enough about that sector or industry, you buy the ETF so you can have a little bit of exposure. All right. If this is helping somebody real quick, just drop me in the chat. Like if you're still with me, if you're still here past 9 o'clock, just drop me in the chat real quick. Okay, I see. Hey, let's go. Y'all still here. I promise I'm almost done. So you're probably like, okay, I don't know what to buy and when to buy it. I'm here to tell somebody here, like if you came here to hear me drop tickers, I've said a few company names, but I'm not dropping any specific tickers. Like I don't do, as my boy Lawrence likes to say, I don't do ticker talk. All right. Tickers can change, they're interchangeable. All right. You have the ability to take this information and look up the information that I'm telling you. All right. Like I just told you, XLF is the ETF for the financials. Each one has an XL, energy, XLE, consumer staples, XLF. Like you can do all this. All right. Just Google it. All right, guys. So you're probably like, Noble, I don't know what to buy and I don't know when to buy it. This is going to help you real quick. And that wasn't a shot at you, Lord Flacco Rennie. I just saw it earlier and it's something that I get a lot of people ask me. So that wasn't a shot at you, bro. All right. The first thing you need to do and know when it talks about what to buy and when to buy it is risk tolerance. This all depends on what you want and where you are in life. And that's why I can't do ticker talk. Because the thing is, I might tell you to put a growth company in your long-term portfolio and you might be 50 years old and that's not the right play for you. You understand what I'm saying? Like, I don't know your situation. If you want me to dive into your situation, book a consultation call and I got you. You know what I'm saying? I got you. But I can't give you the play or the ETF or the stock to buy just because I don't know what your risk tolerance level is. I don't know if you can handle seeing your long-term holding drop 50% and still being like, it's cool. Like, I don't know. You understand? Like I bought Peloton at 100. If you were 60, you would be pissed at me right now. You understand what I'm saying? So it all depends on what you want and where you're going to go on life. Okay. So you need to pick a strategy that works for you. And this isn't just like class, like this isn't a class on strategy, but I'm going to go into a few that in a little bit. But the thing that you need to understand is diversification. Spread out your risk by investing in a variety of securities. That's why we build our watch list. So this way you are mentally and ready to diversify because you've already looked at so many different stocks. Okay. So the next thing I need you to do is I need you to think about your time horizon. Not every stock was meant to be held forever. How long do you plan to hold this company? Because guess what? Companies go out of business. All right. You might not want to hold them forever. You're right. You might just be buying them because it's a dividend play. So the thing is, if you bought a stock and it's a dividend play, you shouldn't be tripping if the stock price decreased in value, as long as they haven't decreased their dividend. You understand what I'm saying? Like, that's the importance of time horizon, because now you're going to be able to say, you know what, if I'm 25 years old, I might be able to hold on to this thing for 5 years, for 10 years, for 2 years, for 30 years. But if you're 50, you might not be looking at that. If you're 45, if you have children, like, you have to know what's going to work best for you. But like I've always said, with any type of investment, inside or outside the stock market, you need to have an exit plan before you enter. So if you are looking at the stock and the time horizon is, okay, like right now, here's a perfect example. We're talking about weed and marijuana. If you do not have the ability to sit on your hands, then that is not the right industry for you when it comes down to time horizon, because it all depends on legislation. It all depends on things out of our control. You understand what I'm saying? So because of that, that might not be the best play for you if that's not something that you're trying to hold on to forever, if you're not trying to deal with the ups and downs. But what you can do is you can allocate your assets accordingly. So for example, if you're 30 years away from retirement, you might invest 70%, 80% in stocks. You might have a few 10% in bonds. You might have 10% in cash. That's asset allocation. Or you might say, I'm 20 years away from, I'm 26. So I might be 30, 40 years away from retirement. I can take the risk to invest in emerging markets. I can take the risk and invest in straight growth companies or straight, lower price stocks. Like I can do that, right? Because of my time horizon, because of my risk management. But then now I need to asset allocate this stuff. You can't, a lot of people get screwed in the long term because they put 80% of their portfolio in one stock or two stocks or all in tech. How many people are over leveraged in tech? Let's be honest, right? Tech looks really nice and fun until the last 3 months, the last 4 months. You understand what I'm saying? Like you have to know how much you're going to give to this specific holding. All right. You can allocate more money to bigger growth names if you're younger, such as tech, such as consumer discretionary. But if you're older, you might have to invest in some consumer staples, in some materials, like because it's not as volatile. And the last thing you have to do is you have to look at the business and economic cycles, because there's always a bull market somewhere. Hopefully some of you guys were taking note of this chart that I put right here. It's a chart that I use pretty often because you understand where you are in the business cycle. When you understand where you are in the business cycle, then you can understand what sectors do well in the business cycle. And this tells you why it's important to be diversified over all 11 sectors. Because no matter where you are in the business cycle, doesn't matter if we're in an early, doesn't matter if we're peak, or doesn't matter if we're in a recession. There's a bull market out there for you. So the thing is, when you have a balanced portfolio, when you're getting hit hard in the last 3 months, your consumer staples, your healthcare is going to carry you through. When we start rebounding in the economy and we start lowering rates in the next few months and the next few years, I think we're going to have higher rates for several years. But when that starts happening, right, we might have consumer discretionary stocks do well, IT do well, industrials do well. So where we are in the business cycle is going to define, or in the economic cycle is going to define what companies that you should be holding as the majority of your portfolio at the time. That makes sense? Like that's how you got to pivot. That's how you have to be able to pivot. That's why I said you have to have an end game. Because sometimes, like if you are holding straight tech stocks, straight consumer discretionary stocks, and you can see the writing on the wall, then you might want to sell out some of that position and bank some of your profit so you don't lose it. That makes sense? Like understand that buying and holding doesn't mean that you never sell. It just means that you sell when you need to. All right, cool. I'm gonna give you 7 stock market strategies real quick, all right? Give you 7 stock market strategies. I'm almost done, guys. Stay with me. I got 5 minutes, all right? 5 minutes. 7 stock market strategies that you can implement right now to help you with your long-term portfolio. The first one is you got to buy and hold. Buy the stock in a fundamentally sound company and hold it for a long time, typically more than a year. All right. There's also tax advantages to holding a stock longer. All right. You get capital gains tax less when you hold stocks for longer periods of time. So when you sell it, you'll get taxed less. That's an advantage holding stocks for a long time. But the buy and hold strategy, that investment, those 10 steps I just gave you, that's where you can do this right here. You can buy on the dip. That's what we've been talking about, several times. Some people are like, bro, I'm not buying on the dip. I don't know, right? Buying on the dip is when a stock you like. Again, I talked about building what you like first before I even talked about entry point, right? When you see a stock that you like and it goes down in price, especially if you believe the decline is temporary, you buy more shares. I talked about when I bought Airbnb at a high price, but I like the stock. So I'm going to buy more of it at these lower prices. And I really missed it because I should have bought it when it hit 125, 130. They reported killer earnings yesterday. So now I missed a little bit of a pullback, but that's okay because I'm buying on the dip. Like I like the stock, so I can buy as I go down. Or you can bottom fish. Bottom fishing is a strategy that you can use, but it's probably more for the people like Warren Buffett and people who have bigger portfolios. But that's when you're bargain hunting. You're looking for stocks that are so low in value that to you, they've hit a bottom and they have nowhere to go but up. Okay. Like these are some stocks like when we talked about, I don't think Apple necessarily has hit a bottom at 150, but what I'm talking about is some of these companies like DraftKings to me, like they're not going to go any lower to $15 than $10 to me personally. Like, and and I only see them going up from here at these levels, because as legalization in sports betting gets more and more, I only see them going up. Like that might be a bottom fishing play. Dollar cost averaging, buying stocks on a regular systematic basis. Now, a lot of people do this on the dip, but they don't do it when it goes up. If you like a stock and it's continuously going up and you have the money to inject into it, do it. And it's okay if your average cost goes up, because you might have the long-term play there. If you're just Apple is something that I'm holding for 5-10 years. Like I'm not selling Apple. So because of that, even though they're at 150 right now, when they go up to 170, I might buy some more. If they go to 200, I might buy some more. But if they dip, I might buy some. Like there's dollar cost averaging on both sides. You have momentum investing. That's what the majority of you all do, believe it or not. When you're option trading, you're just taking advantage of momentum more times than not, especially if you're not trading contracts that are more than 3-6 months out, right? But a momentum investing is, you can do it with your portfolio too. That's buy high and sell higher, right? During the pandemic, Zoom, Beyond Meat, Datadog or whatever, DDOG, what's the ticker on that? You guys know what I'm talking about. Teladoc. These are all companies that did well for that specific time period that we were in. That's how you take advantage of the momentum. But when the pandemic is over and everybody's outside, should you still be owning inside the house stocks? No, you shouldn't. So that's what you sell. Contrarian investing. That's when you go against the grain. That's tough to do. Like your psychology needs to be like on 100, but that's when everybody else is buying one thing, you're buying something completely different. There are a lot of people who've made some good money doing it, but you have to be able to stand the test of time. You have to be able to trust your research and know that you're standing in there, because everybody else is going to be screaming sell and you're talking about it to buy. Like you're going to have to be okay with that. But there are very successful contrarian investors. And I'm talking about people who haven't even shorted. I'm talking about there are people who just see something that other people don't see. And you could study several people who do this and there are a lot of hedge funds that do this. Or the last part is just value and growth investing. Like you're looking for companies that have value. You're looking for companies that have growth potential. And I'm not talking about long shot growth potential. I'm talking about growth potential that you believe in. And you're investing in it. All right. That's the power of the stock market. That's the strategies that you can implement, because now you can do these at different times for different stocks on your watch list. One might be a buy and hold. One might be taking advantage of momentum. One might be bottom fishing, right? I'm not talking about Kathy Wood. That's funny in the chat, right? Like if you're losing money on the contrarian play and you don't have more money to inject in it, you better figure that out. People like Kathy Wood, Bell Ackman, David Tepper, like these people have the ability to sit on losers for a long time, right? But I want to sum everything up with you guys today to let you understand the power of the long game. This was what Jeff Bezos shared in the last in his last shareholder letter to Amazon as CEO. And I want to read it real quick. Dear Mr. Bezos, thanks for making thank you for making Amazon a great company. We thought you would like to know how it benefited our family. Back in 1997, when you had made Amazon public, our son, Ryan, who was 12 years old, and I don't know, is that Vicarious? I think it's Vicarious, man, I gotta get my vocabulary up. And a Vicarious reader, for his birthday in 1997, we bought 2 shares of your new book selling company, which was all we could afford at the time. Within a year or so, the shares split 2 for 1, then 3 for 1, then 2 for 1 again, giving him 24 shares. The shares were in our names because of his age. We meant to put it in custody for him, but we never got around to it. But if he knew they were, because we never got around to it, if he knew they were for him. Several times over the years, Ryan would want to cash in the stock, but we always said we would buy it from him and then eventually turn around and give it back to him as a gift. It was kind of a running joke in the family. Due to the exponential value, we decided to split the stock between ourselves and our children, Ryan and Katie. This year, Ryan is buying a house and would like to sell some shares. After searching for the original certificate, we need to convert the paper copies to digital copies before selling them. You guys got the rest of it, blah, 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 blah. But essentially, right here at the end, included is a copy of the original stock certificate from 1997, 24 years ago. The 2 shares have had a wonderful influence on our family. Okay, we enjoyed watching Amazon's value grow year over year. And it's a story we love to sell others. Congratulations on a great career as a CEO. We couldn't imagine being here. At the time, 2 shares of Amazon in 1997 were trading roughly around $18. $18 turned into today $60,456 based off of the 24 shares that they said they got at the current stock price at $2,519. If you invested $1,000 back then, it would have been worth over $2.5 million today. So I want to ask you all the question, why are we not tripping over the long game? And I know Amazon's the example that people love to talk about. And you're probably like, well, no, but give me another example. Okay, Netflix. And this is despite their recent turnaround. So this stat is before they just recently pulled back in value. Okay, but from the time of 2002 to 2019, I want to say 2020, the company has increased by over 24,000%. But it's traded below their previous 52-week high 94% of the time. Monster Beverage has increased in the last from 1995, I want to say, to 2020, 150,000%. But it's traded below their 52-week high. I think the number is about 90% of the time. So the question to you today is, do you understand the power of the long game? Do you understand what you are missing by not investing today? Do you understand the power of time and the power of quality companies? Because you're spending your money there already, because you're already involved. You're already in the stock market. Your retirement's already there, but it's costing you something because you're letting somebody else do it instead of yourself. And it might not be costing you profit. It might just be costing you peace of mind. Like, I really want you guys to understand that. Like, there's a reason why we talk about the long game, because Warren Buffett is 98 years old, 99 years old, and still running Berkshire Hathaway shareholders meeting. And his net worth only continues to increase. But I guarantee you he's had such longevity in this game with his age, because he's had longevity with his age because he's had longevity in this game. You think he can stay at 99 years old and still run a multi-billion-dollar company if he did not? Over 100 billion, 500 billion, like this is Berkshire Hathaway is stupid how big of a company it is. And he's still able to do that. You know why? You don't think some of the discipline that it took him to hold a stock for 40 years may have come into play when he was talking about his lifestyle choices? Like, do you think it might have helped him out when it came down to some of the things that with his health, or some of the things that he wanted to accomplish, or his mental stability, or his endurance? Like, these are all things like the long game teaches you life lessons. Like, it's bigger than the markets. Like, the money is cool. Like, the money is nice. Don't get me wrong. Like, that's why we're here, is to make money. But I want you to understand that you're doing something bigger here. You're building your discipline. You're building your stamina. You're building your endurance. You're building your mental strength. You're building your resiliency. So the next time when you do face something, like you get a call from your loved one and say that there's been a car accident or somebody's in the hospital, and the doctor said there might not be a way for them to be healthy, or it might take them some time for them to get back to normal. You'd be like, okay, I know what it's like to sit on the long game. Like this is how they correlate, guys. Like, I just want to make sure you guys understand that. And it starts today. It starts with these strategies. It starts with the investment process. It starts with your risk tolerance. It starts with your time horizon. It starts with understanding the economic data. It starts by showing up to pre-market prep every day. It starts by doing the research. And I want you guys to understand that we're new to this. That's why I started off with that. We're only 50 years in the game with this. We as Black people, we haven't been around this long. So it is okay if you make some mistakes along the way. It is okay if there's some things that you might not just get. But if you start and if you be disciplined and you know what your purpose is for this account, I promise you that in the long run, you will make money. I promise you that it will happen for you. All right, guys, that's it for me, man. I know I went a little bit over. It's 9:23. I think I'll keep it open for like 7 minutes for questions. Does that work for you, Bilal? Does that work for you, Seven? I appreciate everybody. If you guys got something from this, right? I just want you to drop a rocket in the chat, right? If this is gonna help you, if this is something that's going to allow you to get to that next level, to fund your account, to grow a little bit more, if this was valuable for you, just let me know. All right. Awesome. Thank you, Jay. Thank you, Asma. Thank you, Devin. Like, all right. I got y'all. I'm glad this helped. I'm glad this helped. So if you have any questions, drop it inside the chat real quick, or I don't know if y'all have the ability to take yourself off mute, but I just wanted to share that with you all today, right? Because like, I want you to know, hey, it's this stuff, buying and selling, it's buying and holding is a whole nother ballgame than options trading. This requires its own level of expertise, but I'm here to let you know that you guys can do it. And it can trickle over into your options portfolio, because you know why? Once you start investing for the long term and you have a long-term horizon, it's only easy to get shorter. So you can look at a company that you did research on and you say, you know, I don't really like them today, but I don't really like them for a long-term play, but I like them for the short-term play. All right. Devin, if you like Netflix and coin at the age of 28. So that's a good question. Netflix to me is in toss-up land right now. I was bullish on Netflix for several years. For some people who don't know, I was part of when I was at university, I helped run a student managed fund. We invested real money on the stock market. We had an investment committee. We had people we had to answer to. We had all of that. Like, we had investment, what's it called? We did research reports. We had analyst meetings, all of it. I was one of the vice presidents. And at the time, Netflix was one of my top recommendations, one of our top money makers. During my time there, in 3 years, I helped grow that portfolio 250,000 to over 700,000, all long-term holdings, and we could not have a single holding get over 10% of our entire portfolio, because that was in our investment guidelines. And we couldn't do any options trading. We couldn't short either. This was straight buy and hold. So I say all that to say, Netflix has been something I've been bullish on in the past. But for me personally, right now, they're in a little bit of turmoil. They're losing subscribers. They pump out so much cash into building out these new shows. They cancel the shows after a few seasons. I think right now they were the industry leader. They had the competitive advantage in the streaming space, but now they have so much competition. You got HBO Max, you got Disney Plus. Disney also owns majority stake in Hulu. They also own the majority stake in ESPN Plus. Like, they also you have Paramount Plus. Like, you have so many streaming services now that I'm not saying that it's done for Netflix, but they needed to diversify well before now. And they were talking about getting into video games and selling apparel, like Stranger Things apparel and some of that stuff. I thought that's like, they should have been moving on that faster. Like, the Netflix originals, they should have been moving to monetize that, like Nickelodeon did with SpongeBob. You get what I'm saying? Like, having action figures and all that good jazz. Like, they needed to be building this stuff out into, like, taking it off Netflix and putting it into real life. I don't think they've done that effectively. So for right now, for me, if you currently have it in your portfolio, you could average cost down a little bit. If you're trying to open a new position, I would hold off just until, and track it, put it on the watch list, but I would need some more news in a quarter or so to help me get over the hump there. Coinbase, that's tough, because cryptocurrency is, something that's very much into the future. I don't know Coinbase's financials that well, so I will say that. But I will say that if cryptocurrency is the future, I just don't know when it's going to get there. Cryptocurrency becoming something that's like mainstream. I know it's mainstream, but I'm talking about like it's widely accepted as payment at just like going to Walmart and stuff like that. That's going to be heavily due to legislation and federal regulation and taxes and stuff like that. So I would say for Coinbase, if the price makes sense for you, it makes sense. But I would have to take a look more at the charts and some of the things that they have going on. But they are the number one industry leader when it comes down to like buying and selling crypto here in the US. But they face so much competition. You can buy crypto anywhere. Why would we buy crypto from them? And their fee is stupid high. So unless they make it, more beneficial to us, I don't see why. I got Nick, you got your hand up, boss. What's up, brother?
Yo, what's good, man? Nice workshop. Definitely am part of the long-term game.
Appreciate you, boss.
For
I've
a
been
couple
seeing the
years.
gems you drop, man, inside the channel.
Yeah, man. You dropped a lot of games tonight. That was like straight up a whole blueprint about how to actually pick stocks. So I hope everyone took notes and is gonna actually do that research that you mentioned. I had a question for the average investor.
Yeah.
Do you think it would be better for someone who kind of just is new to the market or is kind of like just got their feet wet, like they know what the market is, but they like just got to this workshop, not sure how to pick stocks? Do you would recommend them to start their portfolio with ETFs and index funds to invest in the broad market? Or would you rather, do you think it would be a better idea to just kind of buy individual stocks to start with?
Yeah, no, it's an excellent question. I think if you don't know anything about the industry, if you don't have favorites, you got to go ETF, you got to go index fund. You can get as carried away with it as Jim Cramer likes to say, your first 10,000 should be in index funds. Like, I'm managing a portfolio right now for a family member that's over 6 figures. And it's like the majority of it is in index funds. Like I'm not actively trading in that account or actively buying and holding but besides Apples and Microsofts and stuff like that, then the reason why that is just because they're older. Like there's no reason for me to do that. So if you're getting started, I would say start with what you know first from an individual stock picking perspective. So, if there's something that you really like, something that you really enjoy, something that you see building out into the future, start there. But if you don't, bro, go with the ETF. Like for me, I didn't really want to make a play on any of the airlines. So I own Jets, JETS. That's an ETF that just tracks all the different airlines. So if Delta goes up, if American goes up, if United goes up, if Spirit goes up, or this merger that they're coming on with Frontier, like I'm cool because I'm tracking the overall industry. So I think for some people who don't know enough about an industry, like most people, they're not going to know how to do fundamental analysis the correct way over banks. Like banks are one of the toughest things to do fundamental analysis over if you're really trying to run like models and ratios and stuff. So because of that, you might just want to buy XLF, or you just might want to buy a bank ETF that tracks JP Morgan, Bank of America, or you can do ones that just do regional banks such as Regions Bank or First or Fifth and Third. You get what I'm saying? So I think it's a mixture of both, but you need to get started buying. Like that's the thing. Like you got to get started buying because that's psychological. Like you have to start buying. And yeah, it's that simple. So I think you need to look at where you are right now, how much money you have to risk, how much money you have to lose, and then your overall time horizon on it. But I think you should get started at least buying index funds. Bro, QQQ, that's a portfolio staple. And right now, down the NASDAQ, they're getting killed. Like that's a portfolio staple. So I think, for people who are risk averse and they don't want to take all that risk, but your savings account ain't generating you jack squat, buy you an index fund, buy you an ETF, and then buy you the individual like you can't go wrong stock picking Apple. You can't go wrong stock picking Amazon. You can't go wrong. I mean, maybe at certain price points at this point, but Microsoft, you can't go wrong. Like they continue to beat, so I think when it comes down to that, it's good. But I want to say when it comes down to individual stock picking as a beginner, don't get caught up in the hype, man. Like, don't get caught up in the hype. I missed Tesla because fundamentally the numbers never made sense on Tesla. So I missed it, but I was cool with it because of the hype. Like it's just hype. You know what I'm saying? So like at the time it was hype. And by the time I really thought about buying it, it was just way too overpriced for me. So, that's a part of the game and you have to be okay with that. but also at the same time, like, you know, if you stick true to your principles and your rules, you'll be all right.
I appreciate that. And then one last question.
Yeah.
I remember you mentioned that the average like institutional portfolio has like 30 to 25 to 30 stocks, right? Let's say for someone who's also starting out, like same scenario, and like they don't have, you know, like 5-6 figures to kind of pump into a long-term portfolio right away. Like they're kind of in the I'm trying to build phase.
Yeah.
Do you recommend like downsizing a portfolio to more focus on less stocks and funds to be able to allocate more shares of those said companies slash funds, or to kind of super diversify across like many names? Because in my thoughts, and for me, I personally, this is just for me, like I kind of just dumb it down to about 8 holdings that I have, and I'm kind of just, you know, doubling down on everything that I have and kind of allocate as many shares of those holdings rather than trying to like spread it out and only own a few shares of many companies, you know?
Yeah. So let me ask you this question. If I asked you about those 8 stocks that you have, could you tell me what they do, how they make their money, and where they're headed?
Yeah.
Exactly. So you're good. You get what I'm saying? That's why you're doubling down on it, because you have the investment thesis to back up why you're going in so heavy. But if you don't have the investment thesis, or if you don't know, you know, why you're buying it, for me, it's about, you know, getting broader exposure. Because if you're not able, like, you're an experienced investor, I've seen the stuff you talk about, Nick, like, so you're cool with the psychology, I'm sure you are, like, if that one of those 8 holdings go down, you're probably dollar cost averaging down to where it makes sense to you. Like, you're going all in on these companies, right? Like, I've owned IQ. If anybody knows what IQ is, they're like the Netflix of China. That's another thing for my girl who asked me about Netflix. Like, their stock is getting killed, but they're $3 a share right now. I bought IQ back in like 2018 at like $35 a share, right? Like $3, and they're now I bought them at 35. Whoever keeps requesting remote control, please stop. Thank you. Like, I bought them at 35, and now they're at $4 a share, $3 a share, like something like that. Like, I have the mental, I still hold them. I have the mental stamina to be like, okay, I might average cost down. I haven't put any more money into them really, but I might do a little bit more. But like, I'm cool with that. If you're not cool with that, you got to look back at that economic chart that I put out there, that has what sectors do well in which economic climates, because there's not going to be a single stock that's always just going to be like that. I mean, you know that, you know what I'm saying? So I think for somebody who's getting started, you can focus on 1, 2, 3 stocks that you want to build, but I would not get to a point where, I mean, all your eggs are just in just completely like one basket, where if that company goes under, if they get hit, especially guys, if they're a growth company, like if it's a value company or a dividend play, that's different, because you're probably stacking up on shares of AT&T, even though I don't really like them from a price appreciation standpoint. I like them for the dividend. Like, if that's the case, then you need to know that's why you're holding them. You're holding them for the dividend, right? Like, or you need to know, like, but if you're over leveraged and one stock can wipe you out completely, yeah, like I can't sit by and justify that now, but that's just up to your own personal discretion, how old you are, your risk tolerance. But I think a good place to start is, and like I said, I don't think you need to be in all 11 sectors either. Like I said, if you don't know shit about industrials, you don't really need to be industrials. If you don't really know much about materials, you don't need to be in materials. But the thing is, like, in times like now, if you're 75% tech, you just got to understand that you got to be doing something to be pumping more money into that, into those losers, or you got to be willing to make some next steps from there. So I think it could be a little bit of both, bro. But I think realistically, you need to be spread out. Let's just say 6 of the 11 sectors, a little bit, and at least find your secure holdings, though, like you said, your 5, your 6, your 7, your 8, that you're really confident in. And I'm really confident in some of my holdings that I've built a larger portfolio size in, such as Airbnb, such as Apple, such as Spotify. Those are a few companies that I've been holding for a little while that, I mean, even my average cost isn't all the way there, but because I've been averaging down so much in them, they've been growing in my portfolio. but I'm cool with that because I have a long-term investment thesis to go with it.
Hey, I appreciate you, man. You always dropping some crazy game, and you always did, and I love your presentation style and how, you really speak to the people while you present, man. So
thanks, man.
Keep doing your thing.
Thanks, Nick. I appreciate you. We got to do one together, bro. I look forward to learning from you, man.
Hey, let's tap. I'm definitely with it, man.
Let's do it. Paul, before I get you off mute real quick, Paul, let me just answer Tanisha's question real quick in the chat, and then I'll jump over to you, Paul. What do you think about Amazon after the split? Amazon's Amazon. Like, Amazon is Amazon. Their hands are in so many different things. I don't think they're too big to fail, but they're one of them companies that are damn near too big to fail. Like, and the reason why they're doing stock splits is just so they can raise more capital. That's why companies do stock splits, is so that they can make the companies more affordable to you and I. Now, that's why stock splits have not been as common recently, because we can do partial shares. But the thing is, what looks better, $1,000 a share or $100 a share, right? Like, that's what happened when Apple this past, or like, what was it, 2 summers ago when they did their split, or when they were getting up there in price. So, just understand that when it allows you the opportunity to buy them at a cheaper price. And the point of that is for them to raise more capital so they can use that capital to now be able to pump into different investments. So I think Amazon long-term is still Amazon. They're still doing stuff they haven't even gotten the brick and mortar stuff down. They're still trying to figure out how to do that, but they got Whole Foods. They obviously got their stores. They've got the pharmaceutical division that they're building out. They've got drones that they're working on, like Jeff Bezos, Mark Zuckerberg, Elon Musk. Like, these are guys, they are not playing the same type of game as we are. Like, they are looking solely at domination. Like, they are sharks in the water. Like, and you saw Jeff Bezos speak out about Elon Musk acquiring Twitter, right? Like, he threw a little shade at him. But do you know why he did that? Because he understands that's only making him stronger, and he's getting access to the people. But the thing is, Jeff Bezos, he owns Washington Post, so he ain't no different in terms of trying to control news. You know what I'm saying? So keep that in mind when you think about Amazon, and when you're looking at some of these companies that are super overvalued. Just look at them and ask yourself, what are they continuing to do well, but then what also are they trying to expand in, and do they have the bandwidth, do they have the knowledge, do they have the expertise to be able to expand in those marketplaces and be dominant? Amazon expanding into pharmaceuticals, they can still be dominant in that, because pharmaceuticals, there's still an element to what? Delivery in pharmaceuticals. And that's what Amazon has made easier than everybody else. It's not that they have a marketplace that's easiest that everybody can shop at. What's made Amazon so successful is they give you delivery in 2 days, sometimes hours, in a snap of a finger. Like, that's their main thing. You get what I'm saying? So I would keep that in mind when you think about some of the ventures that they get into. What's up, Paul? Talk to me, bro. Jose, I got you next, boss.
Hey, what's going on? What's going on? Quick question. I wanted to get your thoughts on what you felt about for a long-term account, buy and hold account, where, or if you would use margin. Like, say if you just don't have the buying power available right now, but there's a crazy drawdown in the market and you want to capitalize on those prices. When would it be okay to use margin in that scenario? Or if you were looking to build like a dividend paying portfolio where, dividend stocks, there's not really too much drawdown on them. Right. So maybe you could be a little bit more aggressive with the margin buying, and then you can kind of pay yourself back with the dividends, or so on and so forth. I just want to get your thought process on, like, if that would make sense. Obviously it's a little risky because it's margin, but I just want to see your thoughts on, like, if you use margin, or when you would. Yeah, so you ready start to answer the question for me, because I was gonna say it all just depends on your risk tolerance, but I would say no, bro. I ain't gonna lie to you. Margin's just unnecessary, man. Like, if you're gonna do margin, for me, it would more come from a, like, I'm not saying liquidate a credit card. I'm not saying that. But what I am saying is I would not, like, one, your portfolio, to use margin to buy shares in the stock market,
you have to have a substantially size, a substantial size like portfolio to kind of for them to approve certain margin buys. And for me, it's just unnecessary for us. Like institutional investors, you know, when I was working as a financial consultant, like I used to look at some portfolios that used to have margin and stuff, but I don't think it's necessary. If you're concerned about where the markets are currently and you're like, yo, it's buying opportunities, then what I would do is I would focus on what I talked about in my last training, which is just building, like figuring out ways that you can build for ownership. And what I mean by that is you're putting in more hours at work so you can get some overtime. You're putting more time into your business or into your side hustle, or you're creating a side hustle so you can have that money to buy shares. Like for me, I would be focusing on an additional revenue stream, even if it's just an options account. Maybe every option profit that you win, you take 25 off, 50%. You may be more aggressive about how much you reallocate back to your options account and you put it in there. But I cannot recommend using margin just because anything can happen, and you don't know how long we're going to be in this situation. So because of that, like if that stock continues to go down and you've put a sizable investment in that, man, like that's going to be tough. That's going to be tough. So
yeah, I mean, I know that, but I mean, it just in a sense of like, say for instance, right? Because we know we only have, you know, a day, a couple of hours sometimes, you know, when a stock hits a price target and it kind of bounces back, right? So I don't mean like, you know, using like sizable margin, but I mean like, you know, if you're usually dollar cost average, but you know, there's an opportunity on Wednesday, but you have to wait until Friday before you can put more money in. Like I was talking about like in that type of scenario, not necessarily like using thousands of dollars of margin, you know, to take care of an opportunity.
Yeah. That makes sense. I got what you're saying. Same thing though, because we're long-term investing here. So my thing is like entry point really shouldn't be, unless it's something like you're looking at the price on Wednesday, you don't get paid till Friday, but they report earnings on Thursday. Like unless it's something like that, which is like, you know, a pretty unique sequence of events, I would just say either be cool with paying a little extra on the price or just, yeah, I would, or just waiting to see where it plays out at. Because for me, like I don't get caught up in timing entries on my long term. And truthfully, like when I'm
just the accumulation is just the accumulation is just the name of the game for you. Just trying to get as many shares as possible.
Yeah.
Period. I got you.
Yeah. And then, bro, like, because the markets are always going to go up, they're always going to go down. Like, you're not going to miss that. To me, the very few price points that you look at and you never miss again, especially unless it's like earnings or it's, you know what I'm saying? So unless it's something like that, like I say, the chances of that stock or there's some significant news coming out, which again, like that's just bad timing. It's very not from Wednesday to Friday, Tuesday, you know, or a week or 2 week span. Like the stock price really isn't going to be moving that much. And then again, that also tells you what type of stock it is too. Like if it's a growth stock, like that's going to let you know like that volatility is there if it's moving that much in that amount of time. So then at that point, you need to ask yourself, is this something that you really want in your long-term portfolio, or if that's the right play for this portfolio, or, you know, how long you plan on holding it. So yeah, for me, the name of the game is more about accumulation rather than timing when it comes down to this. Save the timing for your options contracts. That's the way I look at it.
Copy. Makes sense. Do you have like a goal amount of shares that you would want before you say like, all right, I'm cool? Do you prioritize certain stocks over others? You know, because I know you're probably on dollar cost average like equally into the whole portfolio. Like, do you weigh things, you know, heavier than others, or you kind of look at it as like once I get to, you know, 1,000 shares or 10,000 shares, then I'm good with this stock and I can focus on other stocks.
Right. That's a good question. So for me, it's like a mixture of both. So I want to accumulate a specific names, like Nick said. Like I'll have my 8 stocks, my 10 stocks that I'm gonna go heavy on, but then I'm gonna have my other ones that are gonna carry the ship, carry the boat if I'm down, right? So like for an example, right, my portfolio has gotten hit the last few months because of because of the inflation and rising rates. But the thing is, like for me, I'm using that opportunity to buy a few more shares of the things that I like. But also I could have gotten hit a whole lot harder if I was fully ported in Spotify, if I was fully loaded in Airbnb, if I was fully like I've owned I've got some Tilray at like 20, 30 sometimes. You know what I'm saying? Like that happens. But am I trying to go crazy on Tilray? Is that a company where I'm like, I want to own 10,000 shares of Tilray? No, like I'm cool on that. You know what I'm saying? But that's a play for me. While dollar cost average down, make my money whenever that thing spikes back up, and then I'm gonna get out, or I'd wait to my investment thesis to like, I revisit my investment thesis often, guys. You know what I'm saying? Like I don't make a play one time or do my research one time and say that's it. Like it's always continuously updating. So for me, I think you should have your staples that Apple, like that you're gonna go hard on. Microsoft that you're gonna go hard on. I'm big on sports betting right now, so I think DraftKings is something I'm gonna go hard on. Like, and that's something I've been buying up, but I gotta go harder because the price, is still cheap. So something like that. But also like, some of the other plays, I know why I'm owning what I'm owning. Like I'm owning this for a dividend play, or I'm owning this because I need exposure to energy, or I'm owning this because I need some staples to buoy me in case there's a 3-month decline. You know what I'm saying? So
Makes sense.
yeah, man. So I know what I'm owning, but the ones that I want to own heavy, I'm going to own. The ones that are just there to balance my portfolio out is there as well. But that's why I also said to look at the S&P 500 weightings, because the S&P 500 isn't equally weighted. Tech is like 28% of the S&P 500. And then you can Google it, you can look it up, but like about how it breaks it down. So like that's normally like if you in the investment world, most institutions like JP Morgan or the Citadel or hedge fund managers, they use the S&P 500 as their benchmark. So the thing is, like, if the S&P 500 is weighted in IT at 28%, if you have more than 28% of holdings in your portfolio, you would say you're overweight in technology. If you have under 28%, you would say you're underweight technology. You get what I'm saying? So the thing is, yeah, so if you're younger, you might be overweight technology in comparison to S&P 500. You might have 35% in comparison to 28% because you're younger. But if you're older and you're a little on the fence right now, you might be a little bit overweight consumer staples than you would consumer discretionary, because that aligns. You get what I'm saying? So that's a good way to start looking about how building out your balanced portfolio is looking at the weightings and the S&P 500, using that as a benchmark, and then also now putting in the money into the names that you like in those individual sectors. But then again, the way that the cookie tends to crumble, you're probably going to be over leveraged or have more money in tech and consumer discretionary in the names that you want to own anyway. You get what I'm saying?
Yeah, makes sense. Makes sense.
Hell yeah. Appreciate you, Paul, man.
No doubt, man. Appreciate it.
No problem. All right, let me go through these real quick. We got about 9 more minutes, man. So, I mean, man, y'all still here. I rock with y'all. Jose, when you're starting a long position, how important are moving averages and indicators for you? I understand time horizon and tolerance may differ for everyone, but is this something you look for, or just dollar cost averaging on dips? Yeah, so I throw my moving averages in there, my EMAs, 50-day, 100-day, 200-day. That all is important. I look at my relative strength, RSI. I look at my MACDs. But in terms of like, I'm not doing like fibs. I'm not doing Bollinger Bands when it comes down to like really long-term portfolio. That's more for my options contract. But yeah, I'll draw some support resistance lines, just try to see where the overall momentum is, because if RSI is high right now, that might tell me that the company's overpriced and there might be a reversal coming. So I won't spend the money. Like to Paul's question, I might wait the day to before I buy that stock. You get what I'm saying? So I don't get caught up in timing the entry. If I like the price, I like the price. But then, yes, the technicals will help you understand where it's going. But then also, you want to also, again, put on those EMAs on there, 50-day, 100-day, 200-day, even a little further out if you care to. I always look at a 5-year chart as well 2-year, 3-year chart, a 1-year chart. You want to be making sure all of these long-term things are hitting for you. But then also when you also are putting those technical indicators on there, it will tell you a good time to buy or a good opportunity for you to get in there without necessarily getting caught up exactly timing it. All right. Thoughts on chip, CHPT, what is that, ChargePoint? ChargePoint's cool. It's a future play. You're making a play on electric vehicles. We know electric vehicles are popping up everywhere, so I do like them long term. I don't know too much about all their competitors. What I will say is that I know Biden has some infrastructure and bill plans that he has specifically when it comes down to EV vehicles and charging stations. And he's trying to put like a ton of charging stations. I don't know if they're at gas stations, but he wants them to be more frequent because there's just not enough charge stations, right? I don't know if you've ever driven a Tesla before, but if you're trying to go out of city, like that shit's annoying. So I think ChargePoint is a good long-term play. You know, they've pulled back. I got a chart up 1 year, 38%, 5 years. They're, you know, they IPO'd last year. So, you know, right now at $15, it doesn't hurt. What's $15? That's a meal. Like, you know what I'm saying? Like that doesn't hurt. So I would say to take a look at it, but then also knowing that Biden infrastructure plays are in the know on this, you want to kind of keep your ear to the pavement, start doing research, try to see and find out who he's going to give these contracts to, like what companies are going to benefit from this the most. But ChargePoint does make sense, but I don't know enough about them from like their revenue, their net income, all that stuff. But a company that typically IPO'd in the last few years, like this is a good time for me to get them because I typically don't buy IPOs because you can see from the 5-year chart as to why that is. ChargePoint went from, you guys can't even see my screen, can you? Hold on, let me try to see if I can click and drag this over here. Can y'all see that now? ChargePoint, yeah, $15 there. So you're looking at like, you know, 5 years, it went up to 46 or so. It dipped on down to $15 or so. So, you know, I would put some moving averages on this. I would put some technical indicators on this for sure. So this way, sorry, I'm looking down because I have this screen over here. So this way you can see if it's a good time to buy or if this thing is going to pull back even more because it's obviously has. Yeah, so that's my take on ChargePoint. So I think $15 ain't gonna hurt you. So it's not too bad. Let's go. Good looks, no problem, Devon. Appreciate you tapping in. If we book a one-on-one, would you help build a long-term plan due to age? Yeah, Jade, I got you. That's what I do. You know, we can sit down and talk through some options about like what you're looking at right now. You know, I don't got to go into detail about like your personal life, but we would go into like, you know, what's your goals? Where are you trying to get to? What's the income that you're currently having roughly? What are your investment vehicles right now? What are you seeing? You know, we talk about that. If you have children, you know, so I do talk about some of that stuff. So we can talk about that, Jay. You know, I got you, girl. So, but yeah, I definitely will help you build that out on terms of a long-term plan. But a lot of that, if you're trying to book a one-on-one with me, it's like, I'm going to ask you the majority of the questions. So if you're going to expect me to sit there and like talk through a lot of stuff, I will, because as you guys can probably tell, I'm very wordy. I'm trying to work on that. But overall, I would need to know like where you're seeing yourself headed. And in the short term and the long term, what your goals are with your portfolio. What do you plan on trying to use your portfolio for? What's your tolerance for losing money? Who is affected if you lose money? Because like for me, I'm the only person affected. But if you got a husband, if you got children, there's more to that. So all that stuff goes into some of these holdings. My Instagram, Devon at Noble Living. We will have access to the PowerPoint. You will have the access to the recording. So yeah, we got you on that. Cool. That's all the questions from me. Does anybody have any other last ones before? I know we got a few more people in here before I get out of here. And Lord Flacco, I hope I gave you some tickers. I think I dropped several tickers in here today that you might be able to use. So man, I appreciate you guys tapping in. You guys have an excellent night. And if you guys need anything, just drop it inside the channel. But this meeting will, oh, Natasha, my bad, girl. What's up? Talk to me. Can we unmute her?
Yeah. Hey, thank you for all of this. So my question is, I already have a full investment with the company I am in at One America, and I'm doing the max this year. And so I think I'm a little confused of how does that work then? Because if I decide to have a self portfolio, does that mean that I put in less in my retirement? And then so it's 20,000, about 20,500 that you could put in your max for retirement for the year. So then do I create another account where I can't put all my max in the work retirement and I have to put a separate amount, right, in a portfolio I'm building by myself? Does that make sense?
So you're essentially asking, since you're maxed out at the contribution for your portfolio, do you have to open up another portfolio for you to invest? Is that what you're asking?
That, and do I have to do less because I can't go over the limit for the year?
Got you. Well, I can't tell you to do less because that's up to you. That's up to you and your risk tolerance, your risk profile. But I have an example that I could give. Like I had a buddy, he and I were having a conversation and he was doing the same thing. Like he was over contributing to his retirement, but he's trying to start a business. He having car trouble. He has other things that he could be using that money for. So for me, I'm more of like, take advantage of the max, but then in terms of the match. I didn't say the max, the match. So take advantage of the match. But if you know that you're going to use that money that you're not, fully maximizing to your portfolio, you can use it elsewhere to build a business or you're saving for real estate or you're using it for something else, then for me personally, I'm cool with that because that to me is how you're going to be able to make more money to then put into your own accounts, into your retirement long term.
Yeah. Just to give you more color. So
yeah.
I max at work because I have a business that I'm up to the low six figures. I don't want anyone to think high six figures, but I'm at a point where my accountant is like, you have no kids. You have to max out of your work retirement if you still want to do that, because your side business or your business is making more money and you're being taxed more now. So it's not, I heard what you said earlier about side business income. So I guess I'm just confused of what I get dinged, or maybe I should just try it and then see what the IRS says. I don't know, but I am interested in long-term investing, learning more about trading, learning more about the whys. I just don't know how. I don't know some of the ramifications, I guess.
Right. So what I will say is this, that is, in terms of the exact blueprint, that is more financial planning. And that's not really my area of expertise. I will just throw that out there. Just because I would definitely consult. I have a friend that I can send you to. Her name on Instagram is Jacqueline Plans, JACQUELINE Plans. She's a certified financial planner. But the reason why I say that is because when you talk about moving money and maxing an IRA, 401k, you are right. There are specific tax advantages to doing things certain ways and to doing things other ways. And you're at that point where, you're making good enough money to where the IRS is going to start hitting you for stuff. You know what I'm saying? So I would tell you to just consult with somebody who has a little bit more expertise in that area, because my expertise is more portfolio building, not really the financial planning side, in terms of retirement and all that. But I think for you in general, when it comes down to the side business income and the maxing, and I'm sure you have a CPA as well, would be somebody that you could talk to as well, because they can help you. And I have a guy as well for that. I think we have a guy in the Discord too who can help you out with that. So, but when it comes down to the overall maxing, I would take his advice and max it. If it's not one of those things where your money is affected or you don't need that money and you're good, max it. Take advantage of it. But what I will say is you want to do the thing that works best for you tax-wise. So I don't know your current situation and all the things that you have going on as to like what the best tax move is, because even your side business, I don't know what the side business is, because your side business could be something where you could be writing off a shit ton of stuff and it could be looking like you're not making as much money as you're really making. You know what I'm saying? So there are a few tax advantages to how you can move around. But what I will say is, you know, you don't have to have your money invested solely in your company max, or you don't need to have it solely in the 401k plan that they have for you and the retirement plans they have for you. You can contribute as much or as little as you want to, and you can run your own portfolio if you are choosing to, or you can run it alongside of it. If you feel more confident, depending on your age, and you said you don't have children and stuff, so you have the ability to take more risk than maybe somebody who does have kids. So because of that, you might have the ability to max out at the job and still build a long-term portfolio on your own. But what I will say, if that's the case, then just make sure the two areas don't conflict. So what I mean by that is, if you have your money manager and you're maxed out on your 401k at your retirement, take a look at your Fidelity or whatever your system is at Vanguard, whatever you use, and see what the risk profile that you are. You in primarily domestic? Are you primarily international? Are you in emerging equities? Are you in large cap blue chips? Are you in small stuff? And I would look at that. And then when you look at that and you see kind of how the money manager is managing that bread, then I would make my long-term portfolio that you're personally managing just a little bit different. Maybe that one's the one that you go heavier in tech on, because your long-term portfolio, your max retirement portfolio, is more in blue chip stocks. Or maybe, you know, you might use this portfolio to buy Chinese stocks and emerging market stocks because your retirement portfolio is only in domestic stocks. You get what I'm saying? So that's how I would navigate. You can definitely have both. I would encourage you to have both, especially if you have the income to do it. But then at that point, then it's just, when it comes down to the specifics, I would just talk to a financial planner or CPA to just understand like what's the best tax advantages on that. But then when you have both, I would just make sure that the strategies just aren't like 100% aligned, unless you're just that bullish on whatever it is. So yeah.
All right, that helped a lot. Thank you for everything. Thank you for y'all.
Yeah, no problem, guys. Man, I had a good time tonight. I appreciate you, Natasha, and I appreciate the 26 people who are still in here and everybody who came out tonight. If you guys have any other questions, feel free to DM me. Feel free to shoot me an @ and then inside the channels, and we'll take it from there, guys. All right, let's get started. Let's make that money. Have a great night. Appreciate y'all.
Thank you so much, Noble. You killed it.
All right, bro. Appreciate y'all. Later.
Good night, everybody.